Everything that happens in the market comes from one thing: supply and demand. When supply increases, price drops. When demand increases, price rises. That's the engine behind every move on the chart. So, if we can't find these zones where supply or demand becomes strong, we can find great trades. The problem is, the beginners usually struggle to spot these zones by hand. They're not always clean, not always obvious, and sometimes the chart moves too fast. That's why I use a tool that makes the process simple. It's called the Flux Charts MTF Supply and Demand Indicator. It automatically marks the zones for you and even generates signals right on your chart. Before I show you how to add it, let me show you how it actually works on the real chart. On the scroll chart, the price moves up into a supply zone. You can see the zone sitting above the candles. The indicator already outlined the area. Every single time price touches that supply zone and gets rejected, the indicator drops a retest signal right on the chart. You don't have to guess. You don't have to draw anything. You don't need a special experience. The indicator shows the rejection spot the zone and tells you with a clear retest signal. The same thing happens on the demand side. Here the indicator marked the demand zone, and when price comes down and bounces off that zone, another retest signal appeared. It's clean and consistent. But there's something even more important. If the zone gets invalidated and price breaks through it, the indicator generates a break signal. So you can trade both the retests and the breaks. But this creates a new question. When should you trust the break signal and when you should trust the retest signal? Following every signal blindly would be a mistake, and you need context. Let me show you an example. Gold has been moving in an uptrend. The Flux Charts indicator marks some supply zones, but trading retest signals from a supply zone in an uptrend makes no sense because that would be trading against the trend direction. In this situation, the retests are actually the low quality signals, while the breaks of those supply zones are the high quality ones. That's because price tends to break through supply zones when momentum is strong. So you want to focus on break signals in that situation. But for beginners, this can still feel confusing. So I'm going to make it extremely easy by adding one more tool, the moving average driven indicator. We'll use it only for trend direction, nothing else. When you add the indicator, you'll get 4 moving averages on your chart: the 20, 50, 100, and 200. We don't need all of them. So open the settings. Disable the first 2 options because we only want the last 2 lines. For the third option, change it from SMA to EMA and make sure the source is set to close. Then set the period to 100. Now change the color to white. Then go to the fourth option, also change it to EMA. Then keep the source on close. And now set the period to 200. And changing the color to yellow would be better. If the lines look too thin, go to the Style tab and make them thicker so they're easy to see. And that's it, no extra settings. Now we have a white 100 EMA and a yellow 200 EMA. These 2 lines are going to help us understand the trend in the easiest possible way. When the 100 EMA is above the 200 EMA and price action is above both lines, the market has a strong upward momentum. When the 100 EMA is below the 200 EMA and the price is moving below both lines, the market has a strong downward momentum. No guessing, no confusion. Just a clean, simple way to know the overall direction of the market. Now let's combine everything and see how to trade this in real time. Look at this chart. The trend is clearly up. Price is above both EMAs. And the 100 EMA is above the 200 EMA. The Flux charts indicator has marked a supply zone, but the retest signals from that zone appears above the price. Since the trend is up, those retest signals would be trades against the market direction, so we skip them. But a bit later, a supply zone gets broken by a strong green candle and the indicator prints a break signal. This break signal is fully aligned with the uptrend, so it becomes a valid long entry. The stop loss should be placed slightly below the EMA lines or just below the recent swing low. The target should be at least 1.5 times your risk. That keeps the strategy mathematically healthy. Move forward on the chart and you'll see the trend continues. Price stays above both EMAs, so the market is still in a strong uptrend. The indicator marks another demand zone, and this time the retest signals line up with the trend. These retest signals of demand zones are in the same direction as the trend, so they become valid long trades. This is where the strategy becomes very simple. You take signals that agree with the trend and you skip ones that don't. Keep moving along on the chart and the story changes. Price drops below both EMAs. The 100 EMA moves below the 200 EMA. Now the trend has turned down. The indicator marks a demand zone again, but because the trend is now bearish, the retest signals coming from the demand zone would be against the trend, so we skip them. A few candles later, the price breaks below the same demand zone and the break signal appears. This time, the break signal matches the trend direction, so it becomes a valid short entry. The stop loss needs to be placed slightly above the EMA lines or above the recent swing high. The target again should be 1.5 times your risk. And if you want to use the Flux charts MTF supply and demand indicator on your own chart, there's a link below this video in the description and the pinned comment. You can get it with a 15% discount. Thanks for watching and happy trading.